My name is Michael Guyett, publisher of the Lead Lag Report. Joining me for the hour, Alfonso Peccatiello. Alf, I appreciate your time and friendship as always. For those who are not familiar with your background, just talk about who you are, what you've done, and what you're doing now.
Well, the first thing I'm going to say, Michael, is that you said your hair is getting gray. I have no hair at all. So what are you complaining about? Give me a break. Anyway, apart from the joke itself, I'm the guy behind the Macro Alf Twitter account. I managed an institutional 20 billion fund for ING, which is a large Northern European bank. I'm Italian, as you probably have already gotten from my accent, which is pretty strong. Um, and at some point, a few months ago, I just decided to quit and basically start sharing my knowledge and my insights and go through this learning journey with you guys. I publish a newsletter which is called the Macro Compass. It's free. It's on Substack. It's where I share most of my thoughts, but also on Twitter, of course, I'm pretty active, trying to make sense together with you guys of what's going on across asset classes. And yeah, I'm also a co-host of a podcast called the Macro Trading Floor, where we invite people, I should say, macro investors across the world to not only talk to us is Andreas Steno and myself, the co-host, about the macro environment, but also share with us macro investment idea every week, an actionable one. We try to basically get out of our echo chamber, as Michael said, and listen to smart guys and try to decompose their investment idea as well. And that's it.
And I'll share that in the space for those that want to check it out and subscribe. So you put out a tweet, Alf, sharing that came from Bloomberg, the chart, and looked at average 6 month Sharp ratios
Mhm.
for a combination of S&P and Treasuries, and you made the point that there has been pain everywhere in the way that this has played out. Diversification, unless you had commodities, for the most part, really has failed miserably, in particular because of the way the treasuries have behaved more as a risk on asset than a risk off asset. I want you to talk about what's happened here, especially the last several weeks with treasury bonds, because as I've been noting, last week in particular seems to be the first time all year where you're starting to see some behavior in treasuries that's more consistent with what you would see when market stocks are volatile. In other words, treasury yields are dropping
Mhm.
on the long end as equities have become more unstable. Talk through what you were seeing kind of more recently.
So, Michael, first a word about the chart you mentioned. Basically, what Bloomberg did there is they looked at rolling 6 months sharp ratios of a basket of asset classes. Sounds very complicated. It's really not. A sharp ratio is a simple measure that looks at the excess return of each asset class above the risk-free interest rate, and it standardizes that return for the volatility of the asset class. So it's basically a volatility adjusted excess return metric. And then Bloomberg accumulated a basket of assets that are very liquid. So they looked at S&P, at treasuries, at gold, and they put them all in a basket. And they were looking at these sharp ratios rolling every 6 months. And the last 6 months was one of the worst, actually the worst period to own just a basket of assets that, as you said before, are supposed to be decorrelated or at least have some diversification benefits. They all went down, just straight down. There was no place where to hide effectively. And the bond market has been one of the places where people have found a lot of you know diversification benefits over the last few years. So think about if we take a step back, Michael, and we go all the way to the 80s or the 90s. If you were to buy a US Treasury bond, you were basically guaranteed to have a positive inflation adjusted return for effectively taking no risk. I mean, that's quite staggering. Basically, you could just buy a 5 year treasury, and after the inflation, you would have had a positive real return. And on top of that, that instrument was amazing because when equities or other risk assets were selling off, then people would try and buy treasuries as a protection. So they also provided a uncorrelated source of revenues to a stock portfolio. That's an amazing asset to have. It not only guarantees a positive real return for basically taking no risk, but it also protects the downside if things are going bad. And we have been used to see bonds act that way to the 80s, the 90s, but actually also after the great financial crisis. Michael, we basically always had people buying treasuries when risk assets were selling off. And why is that? That is because everybody knows that when risk assets are selling off very hard, then you have this reverse wealth effect in portfolios, and so also consumer spending as a second round effect because all the 401ks of people are going down, and maybe house prices as well with the lag stop going up. People are going to be less buoyant when it comes to spending. Ultimately, it's going to impact as well inflationary pressures, and so, we all know and expect the Federal Reserve to ease at that point or later in the future. And so bonds start pricing that probability. And so, it always worked. Bonds served as a hedge for risk assets, but they didn't for the last 9 months or 1 year. And the reason is pretty simple. Well, it's a very expensive thing to say in markets that this time is different, Michael. But this time is different from a certain angle until now, which is that inflationary pressures are much more sticky, are much stronger, and inflation expectations as well are much higher than they were um, after the great financial crisis, which puts the Fed in quite a position. They cannot ease if financial conditions are tightening. They cannot basically step in and provide the proverbial put to risk assets, which will basically signal that bond markets can rally as well. They just can't do that. They're not in a position to do that because inflation is enemy number one, two, three, four, and five. And they told us pretty clearly as well they want financial conditions to tighten. They actually are applauding this move. This is the first time in a while where the Federal Reserve is happy with financial conditions tightening, which means they're not going to ease because of that, which means bonds cannot serve as a hedge for risk assets.
Okay. Now I'm going to push back a little bit because I think there's a distinction between bonds and treasuries.
Mhm.
And what I really mean by that is I'm talking about credit risk.
Sure.
So usually, as you know, and we'll talk about credit spreads in a bit, usually when you're in a high volatile environment for equities, you'll see option adjusted spreads widen, high yield
Mhm.
becomes higher yield. And usually, if you overlay the VIX against credit spreads, it tends to be a one for one relationship. You haven't really seen that as much this year, but historically that tends to be the case. So the question really becomes, will treasuries in particular go back to the way they historically act when you have classic, in quotes, risk off periods? Now, the reason I'm saying that is in my world, as I've shown in all these research studies I've put out there, treasuries historically are the best risk off defensive asset on average, certainly not this year. Right. And that's why I go back to last week in particular was the first time where you started seeing some of that inverse relationship maybe start to creep in. We'll see if it persists. Now, real quick on Sharpe ratios, you and I both know that Sharpe ratios are complete and utter bullshit, right? Because they assume a normal distribution. We know that
Mhm.
that's not how pretty much any asset class works. So, and part of this observation on Sharpe ratios is can explain what's happened in the risk parity space, right? In terms of that mix of what you would think are uncorrelated assets all acting correlated. Talk about if you think that persists and what are the risks of that correlation of everything going down in the same way. What's the risk to the system? Because to me, it seems very obvious that when you're highly indebted, as the U.S. is, you literally cannot be in an environment where yields are rising and stocks are falling. You've got higher interest expense. Oh, and by the way, tax receipts from capital gains collapse.
So basically, there are two questions here that we want to explore together, Michael. And, the first one is really, can we see the move that we have seen in bonds over the last week where they actually start being negatively correlated with risk assets again? Can we see that move persist? And the answer to that question, from my perspective, is no. For the time being, we can't see bonds having that nice property we all wish they have the whole time until you literally start seeing inflation slowing down. And I want to stress out one point. It's not only that inflation needs to slow down, it needs to slow down at a pace which is equal or faster than what the Federal Reserve and the forward inflation market is already pricing in. And the composition of the slowdown needs to be a friendly one, which means also the stickier components of the inflation basket need to stop going up because they are going up. I'm talking about shelter inflation and other core services prices. But back to the main point, the reason why the only way for bonds to rally here, basically, for the time being, is that if inflation slows down, is that would allow the Federal Reserve to take some of the tightening pressure off the table. And because the bond market is pricing quite an amount of tightening in front of us, with terminal rates all the way up to 3% and quite a fast tightening cycle, if the Federal Reserve would be able to take some of that pressure off, then obviously people buying bonds will have, tailwind. They would have bonds pricing in quite a tightening, and if that doesn't unfold, then effectively you'll find yourself with an asset that makes you money, which is bonds. Now, uh, we are all basically talking about either inflation slowing down, or we're talking about things having to get much worse before they get better. And if they get so worse to the point where the repo market stops functioning well, the credit market stops functioning at all, where basically we have companies that can't get a refinancing window, like it was at the end of 2018, where the junk market was basically shut off for 47 trading days. It's basically 2 months, if you were a highly levered high yield company, you couldn't refinance at all. If you basically break the functioning of the credit and the repo or the treasury market to a point that is really bad, then perhaps the Federal Reserve has to step in. But it is not that if the S&P drops another 10%, the Federal Reserve is in a condition to say, "Oh, no, 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 that's too much, guys. We're now gonna, take some of the we're gonna take the foot off the gas pedal because that's too much." This is not 2013, this is not 2017, this is not 2018. The situation is vastly different because of realized inflation and inflation expectations. Policymakers, Michael, have generally um, a linear response to inflation and inflation expectation. And what I mean is, if inflation moves from 1.5 to 2.5%, and inflation expectation move as well the same way, what they would do normally is they would tighten in a linear fashion. So they would say we're going to raise interest rate linearly, we're going to reduce the balance sheet linearly. The same happens if inflation is dropping from 2.5% to 1%, or inflation expectation too. They'll have to ease. They'll do some QE, they'll cut rates. Now, the problem is that this linearity in response actually starts to become convex and nonlinear when you approach certain levels that make policymakers very uncomfortable. Which means if inflation expectations are 3.5%, if core inflation is printing at 5%, at 6%, the latest inflation report showed that month-on-month core inflation is actually accelerating compared to the pace we need to bring inflation down by the end of the year. Again, it's accelerating compared to the pace we need to bring it down. And also the composition was unfriendly completely, if you ask me, because core services prices, which are the stickiest part of the inflation basket, were the highest in 40 years in terms of rate of change, year on year, month on month, doesn't matter how you slice and dice it. But, inflation pressures are broadening. As we expect, they're moving towards the stickier parts of the inflationary basket. And on top of that, the pace isn't slowing down nearly enough. On a month-on-month basis, we're actually going up compared to last month. So if you put all of this together, Michael, I just think that the bond market will have a hard time rallying unless something seriously breaks. And I'm sorry, but a 20% drawdown in the equity market at this stage, because of the incentive scheme of policymakers, is nearly not enough to make them budge.
Okay. So now this becomes, and I'll bring in Jeremy and Axel and Cole in a second, but I want to go down this a little bit more. So my personal thesis is that you will see rates rise and fall at the same time, and what I mean by that is you'll see the corporate credit side keep selling off as far as yields widening, while treasuries again go back to that historical risk off, which is again what you typically see in high volatile periods for equities, except this year. But you mentioned that that drop in equities is not enough. I wonder though if the drop in crypto is enough. And here's where I'm going with that. Um, I put out this tweet a little bit earlier, and I think people forget when they look back at 2008 that when Lehman Brothers filed for bankruptcy, the initial reaction by the market was actually a nothing burger. Nothing really happened. I believe it was Hank Pulse and others basically kind of alluding to the idea that it's clear that Lehman was not a systemic event and that the markets were handling it just fine. And then a week later was when the real bulk of the great financial crisis, the crash, happened. It was with a lag. Now, obviously, it's a different dynamic in terms of leverage, but it's still leverage in the cryptocurrency space. I want you to talk about if you've thought about how this collapse in cryptocurrencies might perhaps cause a lagged systemic event on other asset markets, because if everything is correlating the same way on the downside, and that is a an asset class which has more leverage than others, it doesn't seem that low probability of a situation where stocks could react very badly to what we saw last week, again, with a lag, similar to Lehman Brothers.
Of course, the leverage involved in crypto is pretty high. One should say there is a lot of shadow credit creation going on in the crypto space, which is, so far largely unregulated. It's the nature of a new market where regulators are now, Michael, obviously gonna go and try to tighten up that space, especially after the Terra Luna story that we have seen, where stablecoins all of a sudden were not that stable anymore. So we are going to see some regulatory pressure there, but nevertheless, the inherent leverage which is present in some of the crypto space makes it, a an interesting asset class to watch. And the way I always look at asset classes, Michael, is I standardize their market cap for the implied volatility and the realized volatility that they have. Let me try to explain. So if I looked at the total market cap of the crypto space, let's say, well, I don't have the numbers in front of me, but at some point in November last year, we were approaching 2 trillion, summing up all the quoted coins out there. Okay, cool. Now, the global equity market is a market of about 120 trillion dollars market cap globally. Okay, so we're talking about something that is about 50 times smaller, 50 to 60 times smaller in terms of size. Now, let's look though at the implied and realized volatility of these asset classes. So if I look at the realized vol of, the S&P 500 in periods of low volatility, then I end up in 2017 and I'm looking at, a 12, 13% realized vol. That's very low. And if I look at the average realized vol of the S&P in a year, that's right, round about maybe 20%, slightly lower than that, barring years of crisis like 2008 or 2020. So let's call it 20%, all right, just to make an average. Now, if I look at the realized vol and the implied vol of, let's say, Bitcoin, just to take the largest market cap coin amongst the crypto space, I am looking at an asset that has a realized vol of around about 100%, 80, 100%. So it's 4 to 5 times more realized volatility than equities, which means that despite being, yeah, round about 50 times smaller, it still has 5 times realized vol, which makes it in volatility adjusted terms meaningfully larger than you would expect, Michael, just by looking at the size of it, right? And this volatility is important because it effectively creates a basically a wealth creation and wealth destruction, which goes on, and it creates additional leverage in the system that then can theoretically unfold into other asset classes too. Now, I don't think we are at the point where the crypto space is system. It's a systemic asset class that can therefore just bring up a domino in other asset classes, but I think it is also pretty myopic to just look at it and say, it's 2 trillion, it's nothing. Well, the leverage in it and the realized volatility and implied volatility make it a much larger asset class at only between brackets a 2 trillion asset class. What I think it is an asset class with a lot of leverage, Michael, and pretty big, where people pay, not much attention to it, but things are moving, is the global real estate market. On the macro compass, I put out a chart that shows that the global real estate market, summing up residential, commercial, and agricultural land, is about 300 trillion. Now, if you remember, the equity market is about 100. So I'm talking about an asset class which is 3 times as big as the global equity market. And on top of that, it has much more inherent leverage because of the mortgage market underlying it than the equity market. Now, that is big, that is huge, that is systemic. And there I think we should pay some attention. Jeremy, thanks for the question. Pleasure to have you in the Twitter space. So the way I think about it is twofolds. I have a model for the equilibrium real interest rates in the US, R star, and that points to, of course, a range of outcomes is a non-observable metric, but from my estimates, we are at around 0%, which means the US economy can bear a risk-free real interest rate of about 0% to deliver their potential GDP growth, which is the sum of the labor force growth and productivity growth, which is about 1.5 to 2% a year. That has been declining since the 80s. It's not the news. It has to do with the technology demographics, with the unproductive burden of debt in the private sector, in the public sector, etc. And as you pointed out, the measures of real interest rates out there in the market, I look at several indicators. My preferred one is 5-year forward, 5-year real interest rates, because it allows me to take, the most liquid inflation swap out there, which is the 5-year inflation swap. And from the nominal term, I look at the OIS curve, 5-year forward, 5-year, which also allows me, Jeremy, to basically look through the next Federal Reserve cycle and rather focus on the medium term, which is the basically 2027, 2032 part we are considering with the 5-year forward. It's a cleaner measure, I think, and that one has gone up to plus 50 basis point. So 5-year forward, 5-year real interest rates, as I measure them, are plus 50 basis point, and the equilibrium is at zero. So, of course, risk assets are puking. Of course, credit spreads are widening because you're tightening monetary conditions and credit conditions extremely quickly for the private sector. And also the pace of change matters here. But normally speaking, in 2018 at least, on my metrics, anytime we were between 50 and 75 basis points above equilibrium, things, in the public market, in the credit market, crashed to a point where the Federal Reserve had to intervene. Again, this time is a bit different. And I'm afraid the pain to aggregate demand that the Federal Reserve want to generate requires a longer and stronger tightening of financial conditions that we're used to, because they have a big supply problem. They can't do anything about that. They can't make the ships at the port of Shanghai load and discharge more quickly. They can't make Ukraine export more sea flower oil or wheat or neon. They can't solve the energy situation as well. So obviously they can only hit demand, and I'm afraid that they'll have probably to tighten the screws a bit longer and a bit more that we are used to. So I would expect that honestly I can't get myself long here in bonds simply because I can until I see actual progress on inflation that will give the Fed respite and will give them basically carte blanche to take the the foot off the gas pedal. Until that happens, honestly, these guys will just have to tighten things up. And as they basically tell you that they don't want financial conditions to ease, including they don't want bond risk-free bond yields to drop, I'm generally inclined not to fight the elephant in the room, which is the Federal Reserve. Fantastic questions, Axel. There are basically two again in there that we need to decompose. Um, as a risk taker, former risk taker by now, I'm generally inclined to think in first round effects first. So, and that is reflected in the trades I have on. I am short BTP and long bonds. I am short credit spreads in the US by shorting LQDH. It's an ETF that basically gives you investment grade corporate spreads. So it adjusts the interest rate risk in LQD, and I'm short the S&P as well. So basically, the main theme there is to be short a basket of assets that will have to basically get things worse before we get better. And so I do believe that the pain we have seen until now is just a reflection of some of the tightening we have seen, but there has been nothing nearly close to a convex liquidity event in these weaker balance sheet entities out there. So let's say, corporate spreads, or let's say Italian government bonds in Europe. Those have moved, but the move hasn't been at all something extremely, convex or scary. And I think we'll have to see some pain yet there. Um, Again, because the only thing that central banks can do here is trying to tighten up credit conditions to the point where ultimately the private sector is choked off and demand slows down that much that you have a negative impact on inflation too. Which brings me to your second question, which is, okay, Alf, but if let's say the equity market drops another whatever 10 or 20%, and more importantly credit spreads start to widen in a serious fashion, so that corporates can't lever up in an easy way, so they'll have to scale back investment plans and hiring plans and all of that, and by a second and third round effects we have the economy slowing down. Does this automatically mean that inflation is going to slow down too? And that is quite a valid question. Uh, of course, if you hit demand to the point where people, lose their job, that is really the key driver. Then, it's going to be probably that bad that the demand slowdown is going to more than offset some of the potential supply bottlenecks that are going to last. Can that be the way we go through it? Yeah, probably. But in the meantime, the real question here is, the slowdown in demand via the wealth effect and tighter credit conditions takes a while to unfold. And so while we go through that process, how is the supply side of things looking like? And looking at China, looking at Russia, Ukraine war, honestly, it isn't looking any better, if you ask me. So throughout this process, with the broadening of price pressures that we are seeing in the services sector too, and with the supply bottlenecks that apparently aren't working out to solve very quickly, while the demand slows down, central banks will try to slow it down even quicker, especially if they're not getting any actual progress on inflation. So from an investment perspective, I think the safest way to express this is to go and chase the items in the financial condition index across the world that have suffered the least and that have the worst balance sheet metrics out there. And those are, I think, credit spreads, very, very simply. So in Europe, it's Italian government bonds, and in the US is credit spreads. And I think those will have to widen more. This is a valid question. So, on the fiscal side, I think the US has been very vocal that fiscal is very important to bring inflation down, which translating it means we are not going to print any deficits. And they've been effectively, uh, you know, um, sticking to that narrative. If you look at the Treasury General account, it's up to almost 1 trillion. We've had a pretty large season when it comes to fiscal receipts. And the Federal Reserve is not going to just issue more bonds on top of that. They're just going to sit on the Treasury General account, which basically means they're relatively happy to drain resources from the private sector. And it makes sense, right, Axel? Because if you want to slow demand, you do not throw more resources to the private sector, you drain resources from the private sector. When it comes to subsidizing the energy story, yeah, of course, we could see some of that intervention. There has been a headline that Europe is considering redirecting some of the recovery fund unused resources towards subsidizing the energy story. But again, that is basically trying and cover some of the real income holes that the energy price increases have generated in the household's balance sheet, especially in Europe. It's not an additive fiscal stimulus; it's a repair attempt. So I think actually, if you ask me, the fiscal authorities around the world are very cognizant that they also need to pull out the brakes rather than accommodate further and give further resources to the private sector that would boost aggregate demand, while the intent from policymakers is clearly the opposite, is to slow aggregate demand here. No, I don't expect Italy to fail or credit spreads to move to 10% in the US, but what I do expect is that we're going to have some pain in front of us. And obviously, Axel, all these trades are negative carry. People are not paid to sit on their cash or to short risk premium. They're normally paid to harvest risk premium. So I'm doing the opposite, and I'm cognizant that these trades bleed carry through time, and that on top of it, generally speaking, policymakers are not very keen in seeing the sky fall apart. But that doesn't mean that between now and the situation where they will be, their incentive scheme will have been, would have changed enough for them to consider intervening. There is quite a way to go. And I always do that with BTP Bund spreads. I always tell people, okay, we are at 180 basis point. I entered the trade at 150, even tighter. But let's look at it now, 180. Okay, we're 180 basis point. Is that anywhere scary? Not at all. If you look at the history of Italy, even in idiosyncratic political situations where the ECB theoretically could have said, guys, I mean, you sort it out yourself. It's an internal political story. They tried and verbally intervene anywhere around 300 basis point. Above 250, 300 basis point, it generally creates some trouble. We are way, way, way off that. And on top of that, the European Central Bank is for the first time since 2011 facing inflation expectation, which are in the short term way above 3%, which makes them their ability to come and ease, of course, much more watered down than it was throughout between 2013 and 2019. So that incentive scheme is already much more skewed towards not being able to intervene, at least verbally. And on top of it, we're far away from levels that would, really make them nervous, which suggests that the risk reward in this trade is favorable. And again, it's not about Italy defaulting, it's about making some P&L out of things. So if you go closer to the point where you believe that authorities can intervene because their incentive scheme is changing, because Europe breaks down if Italy is allowed to fail. Then at that point you're more conservative and you take profits. But actually, I wish we get to that point because it would mean I've made large profits on the trade. I think I want to summarize for people for a second where the returns from the stock market come from. And ultimately, it's three sources, but mostly two. One is the dividend yield that you lock in when you buy stocks. That contributes not much nowadays to the total return. The two most important things are earnings growth and changes in multiples compared to the point where you decided to enter the stock market. And so, if I look at the return that equities have generated over the last decades, actually, especially in the US, earnings growth have represented quite a portion, which might be surprising to a lot of people. But US companies have been able to benefit from large earnings growth, both generated in the US but also outside. And that has been quite a tailwind for U.S. equity returns, and of course buybacks and changes in multiples have contributed to a large extent. So basically, your question is, if I look at the future returns from an equity portfolio today, can I expect what is the long-term average return I can expect or expected return in an equity portfolio for the next decade or so? And the answer to that question is, well, it's positive, I would say, which is already good news. The reason is pretty simple. Again, people are not paid to sit on their cash, but they're paid to harvest risk premium, which means that if you put your capital at play, you are normally retributed with at least earnings growth. And as the world continues to, deliver some productivity gains, although the amount of people in the labor force doesn't expand as quickly as the 80s, with the help of leverage and with the help of margins, corporates generally should be able to generate earnings, which makes you effectively in a distribution of potential returns a bit skewed to the right because you don't start from 0%, but you start from a positive dividend yield and a most likely to be positive earnings growth. Now, valuations are obviously the problem. If we are switching regimes and we are in a situation where inflation expectations and realized inflations will have to move to the right a bit because we deglobalize, we move towards more supply constraints, the energy policy becomes a mess, and all these on-time supply chains we have relied upon over the last 20 years actually are broken because of what we have seen happening with the war and the COVID, etc. That could be an environment where inflationary pressures are slightly higher than they were over the last 10 to 20 years, which also makes central bankers, you know, much more. I would say it makes them refraining from having an ultra accommodative policy the whole time, which then reflects in real interest rates being higher than they were over the last 10 to 20 years on average, which also means that valuations are, which are not, we should not be looked into a silo, as I put on Twitter a thread yesterday. They should also be compared to the yield you can generate on a risk-free instrument. And if that is changing because inflationary pressures are changing, and also the tailwind from multiples and from valuations is probably to be expected to be slightly negative. So if you believe that inflationary pressures are here to stay on a more structural perspective, and you believe that corporates cannot pass on this inflation to the private sector forever, and margins have to squeeze and valuations have to come down a bit, then one might want to argue that the stock market is probably about to deliver returns which are subpar over the next decade compared to the ones that have been delivered over the few past decades.
And by the way, I shared in the space. I keep making this point that there's some things you typically don't see at bottoms. The fact, on a side note, that Eric Balchunas shared this tweet that ARK had the biggest week of inflows in over a year. I see stuff like that. I see sentiment around Luna that it's time to buy by a lot of uneducated speculators. This is not typically stuff that you see, by the way, at washouts. So to your earlier point, Alf, would suggest that this is not over and goes back to the name of the space. The worst is yet to come. I'll let Michael Kantrowitz come in, but I felt like that's worth kind of mentioning because I just don't think the sentiment is at the despair puke point yet.
So, Michael, are you asking me whether I believe a bottom is close or? And you're a very smart guy, so I'm afraid you know already the answer. But top of my head, I cannot think of a situation in recent history where either monetary policy had to shift very dramatically to support the economy and the stock market in general, or that the impulse of growth had actually turned, which doesn't mean that we were growing all the way above trend, but at least that the second derivative of growth had changed to be in a positive shape. I can't think of any episode outside those.
There might be one example, Mike. I'm just thinking off the top of my head, although it ultimately wasn't the real bottom, was after the 29 crash. Because 1930, you had the Dow off the low, I think, rise something like 30%, and then ultimately you had lower lows after that. But I don't think that rally off of the 29 crash was associated with any kind of policy change.
Well, my answer to that is I'm short the S&P 500. I'm short credit spreads, and I'm short BTP Bund spreads. My trader public, my track record too. So, guys, I am bearish here for the exact same points. For me to change my mind, I actually need at this point to see. Well, the fact is, even if the real economic growth impulse would somehow turn to be positive again, actually would that overshadow the fact that the Federal Reserve would probably get even more nervous at that point because aggregate demand is picking up. Oh my God, we have already core inflation at 6% almost, with services inflation, core services inflation at 6% year on year, and now the economy is picking up. I mean, the Federal Reserve wants the economy to slow down, so I'm assuming that part is going to get done, and Sure. I mean, that part is probably going to get done. And on top of that, they're not going to ease policy unless inflation starts to meaningfully slow down at a pace that is convenient for them. Unless I see one of those two happening, I'm going to remain short. It's pretty simple.
No, and Mike. By the way, that's why I said that before, and people were not quite understanding my point. It's like this is like the mother of all black swans because you've got black swans happening in multiple asset classes in all at once in a coordinated fashion, right? Which makes this really remarkable, I think.
I agree 101% on this. And to be honest, I mean, this is the first time I can remember where I can picture the FOMC members cheering in days when the S&P is going down. That's all I'm going to say. I mean, like, the guys want financial conditions to tighten. They've told us extremely explicitly. And now you can give me any chart you want, but when it comes to real economic growth, I have a bunch of indicators, forward-looking indicators, that are somehow statistically significant. The most famous one I use a lot is the credit impulse across the globe, measured in the right way, because it basically says whether the private sector is getting more resources thrown at them or less resources thrown at them. And when you throw more resources at the private sector, I'm talking about spendable bank deposits. So when you throw more of these at them, then there is a good chance they're going to use some of those with a lag, and they're going to go around, they're going to spend, and earnings are going to go up, and employment is going to increase, and all of that. And now we have seen the largest drop in the credit impulse metric that I track across the five largest economies in the world that I have ever seen in my series. In terms of and this is a second derivative, so it measures the pace of change of credit creation. We have basically withdrawn credit at the fastest pace ever, and now we are making it even more expensive for companies to borrow, for people to get a mortgage. So I'm not really sure why people expect economic growth to trough at some point and to turn up again. I would say we are trending down. We are going to print below trend growth this year, quite below trend growth, if you ask me, and things are not improving anytime soon from that perspective. And when it comes to valuations and financial conditions, the Federal Reserve does not want things to improve from that perspective. So all in all, I'm just short.
Well, hold on. That's interesting because the Fed has made this point before, and I do believe this also intuitively. The wealth effect that the Fed really cares about is not in asset prices and meeting the stock market going up. What they really care about most is housing, right? That seems to be when people talk about the wealth effect and the Fed's trying to target it. That's really what they're targeting. But go ahead, Alf.
So what I would say is that, yeah, this is a relatively inefficient way, but Axel, the Federal Reserve has a very blunt couple of tools. They have interest rates, and they have, let's say, the balance sheet, or in an indirect way, financial conditions. And the problem with those tools is that they're very blunt because they just affect almost they're one size fit for all, right? But ultimately, if you look at the aggregate economic drivers, I think they're still going to achieve what they need to achieve, and the reason is pretty simple. Our economic system is based on continuous credit creation. Since we depegged from gold or any other hard asset with credit creation, commercial banks and the government can just make a hole in their balance sheet and throw resources at the private sector and print spendable money. And that's what we have been doing, and we have been levering up the private and the public sector for 40 years. So if you stop that levering up, because what people fail to understand is that it is not the direction of travel only when it comes to credit creation, but it is the pace. So it's the acceleration or deceleration in that credit creation that matters. If you all of a sudden slow down credit creation because you simply make it unaffordable for corporates to refinance, you make it unaffordable for people to get a mortgage, or if they want to get a mortgage, then they'll have to bid up for a house at 10 or 20% lower price because their salary hasn't increased anywhere near to compensate enough for the higher mortgage installment. So when you make it, when you tighten up mortgage rates and corporate credit and all the access that the private sector has to credit, you are literally, on a very blunt way again, you are just one size fit for all, making credit conditions very tight. And when you do that, obviously people are going to dial back on their borrowing and on their leverage. And when they can't refinance, they're going to shrink their balance sheet. And when they shrink the balance sheet, they're going to hire less, they're going to spend less. And then when you look at the second derivatives of all of that and the rate of change and the impulse, it actually works. You have to give it a lag and it works. It's a very inefficient way, I agree. But ultimately, what can the Fed do? They don't have a system to do tailor made monetary policy. That might come with central bank digital currencies at some point, but for now, that's not available. So they're just going to shoot in the middle.
And by the way, I will add real quick. I'll add real quick that you mentioned January, and I mean I've made the case that a bear market really started in February of last year because that's when breadth peaked and a lot of underlying stocks started decelerating, right? But it kind of goes to the event
Wait,
versus process. Right. It's everything in from an intermarket perspective started really diverging February of last year. That's also and Michael Howell of Cross Border Capital I've had on before. I'm going to have on again soon. Noted that also February is where, based on liquidity measures he looks at, that's when that started turning down. But I want to go to Alf. Alf, if you want to respond to
yeah.
that, and then we'll get
So just
to
to
Wade and stuff.
clarify my point of view on when things peaked, I think returns should always be measured in a real term and not in a nominal term. Because what we try to do at the end of the day with our portfolio, guys, is to at least preserve our purchasing power. So that means that we need to beat inflation. And if you look at the S&P return from April 2021 to at some point March 2022, so not even up to today, the nominal return was below the realized inflation already. And now, of course, we're much lower than that after the last throwdown. So, in real return basis, one might argue that the stock market stopped delivering positive real returns somewhere in spring of 2021. Uh, when it comes to the length of this bull market and your question, JK, it's it is actually very hard for me to foresee whether this is just um, a short bear market where we're going to drop 30% peak to trough and then we're going to just stabilize there. Because again, as discussed before with Mike, uh, at the moment, it is hard to foresee a reason why we would resume the bull market anytime soon. It is really difficult to foresee. Can that change in 6 months from now or in 3 months from now even? Yes, of course it can. So let's assume that Ukraine and Russia somehow sort it out. And then let's assume that China stops zero COVID policy. Let's assume that also all the supply chains in the world get sorted out extremely quickly. Well, a lot of the inflationary pressure and supply bottlenecks are going to be, pretty much eased down aggressively. And on top of that, all this credit tightening we have seen will have fed already through the economy to a certain extent. So aggregate demand will be lower as well. The combination of the two will make inflation lower, following, this slowdown that the Fed expects. And then by the end of the year, the Fed can be like, guys, it's going according to plan. We don't need to tighten all the way above neutral rates. We can just, stop the hiking cycle at 2.5%. We're going to sit here and it's all going to be fine. And the economy will be printing still decent GDP growth and earnings will be fine. Yeah, then I can guarantee you that the stock market will probably print positive real returns in the time span following that. But how many ifs did I mention? Quite a lot of ifs, right? So it is very hard to foresee, to be honest, at this stage. The only thing is looking at the first round effect, so looking like 5, 10 meters ahead of me and trying to, tactically time this on a 3 to 6 months horizon. As discussed before, there are no strong reasons to be long, rather than people trying to tell me that 12-month forward PE of companies are now attractive. And so my question is, attractive to what? Because real yields, so risk-free basically returns investing in treasuries and looking at inflation expectations down the road, are much higher than they were in 2017, which is the comparison you're using to tell me that PEs are cheap. But the real yields are much higher today. So the risk premium basically has not widened yet. I haven't seen credit spreads blow out. I haven't seen equity risk premium blow out, which doesn't even make the sole valuation argument attractive to me. While I have, I think, pretty decent argument on the financial conditions tightening and on the fact that inflation expectations are, relatively scary for policymakers. The reaction might be convex. The economy is slowing down. I just think it's a sounder and safer case to remain bear over the next 3 to 6 months. And things, of course, can change. We should be nimble. If facts are changing, I will change my mind. My trades are public. You will see me updating it. Then I can be wrong. I'm wrong about half of the times with my trade. So just take it with a pinch of salt.
And I will say real quick, I will say there's a distinction between, I always make this point, the difference between the end point and the dance in between the end point, because we know you can have these face ripper rallies in bear markets, and I keep making this point that bear markets make both bulls and bears humiliated because of the way that the sequence of returns ends up playing out. Just give in the interest of time, I just want to go to.
I also believe that earnings expectations are way too high from an analyst consensus bottom up perspective. Again, if I look at the credit impulse metric that I have, it tends to lead earnings growth by 9 to 12 months in a very nice way. It's on the Macro Compass, my free newsletter. If you want to check it out, it's one of the latest articles. I updated the model there, and it would point to earnings growth in S&P 500 to be in the low single digits this year at the very best, and we're having analyst consensus still around 9 to 10% year on year. So earnings, according to my models, haven't really repriced yet. And even if, I mean, even assuming that the E is wrong, let's assume my models are right and analysts are wrong, and so the E of earnings will realize lower, then the mere valuation perspective again it isn't valuations should be looked at in a silo. People don't are not like I either buy the stock market, looking at valuations, or I do nothing. Nothing doesn't exist. Bank deposits are the alternative. Risk free real returns are the alternative, which are treasury bonds in most cases. So that's where you should look at. That's the starting point. It's not nothing. Those bank deposits need to be parked somewhere, either at a commercial bank or in a risk free instruments, which is treasuries. And if you look at the real returns that you can get nowadays by buying a 5 or a 2 or 10 year treasuries and looking at inflation expectations down the road, they are positive. And so you should look at valuation in that context. And on top of that, overlay the chance that the E of earnings might be wrong too. So to be honest, that argument doesn't hold for me that, valuations are cheap and all of that is fine because of what I just mentioned.
It's also, as we know, very hard to create a strategy and entry and exit points based on valuation. I think that's, and I've done a lot of back tests on that. It's people often reference valuation, but it's hard to actually create an actual implementable strategy around that.
Yeah, one thing I'd like to say is that I like to think in terms of probabilities by being an investor. So I know I will be wrong. In my investing career, managing this large fund, I've been right 54% of the times and wrong 46. Around about 50-50, right? What makes me, or I should try at least to be a successful investor, is to have my returns basically being larger than my losses when I'm wrong. And so I always look in probabilities, and I'm like, okay, what is the payoff of this structure against the probability that I have in mind? And if I think there is a large skew for a good reason, then I'm up for it. And now looking at interest rates, for example, yesterday I was looking at the EDZ3, so that's the Euro Dollar December 2023 contract, and I was looking at the put spread struck at around 95 strike. So let's say 95, 95.01 to make it struck very close. And the price you need to pay for that put spread is about 3 cents. And if you're right, you get a payoff, generally 7 to 8 times of what you put up front, which tells me that the market is expecting a 15 to 20% maximum probability that by December 2023, LIBOR rates, which are the underlying for the euro dollar future, are going to be above 5% because the 95 price is calculated as 100 minus the yield at that point, right? That's how Eurodollar contracts work. So you have to ask yourself also from an interest rate perspective, and we all know how interest rates are important as a driver of many other asset classes, including equity, including valuations. The bond market is assigning a 15% probability that the Federal Reserve has brought Fed funds all the way to 4.5 or 5% by December 2023. So is that probability high, low compared to what I have in mind? Well, I don't really know. I mean, we are at a point where if supply bottlenecks persist and inflation doesn't slow down as the Fed wants it to slow down, their reaction is going to become more than linear. It's going to become convex. They really have to put themselves ahead of the curve because at that point is a serious risk of loss of credibility. And the most important asset of a central bank is credibility, is forward guidance, is the market listening to them. It's the curve behaving as if they understand what the message is from the Federal Reserve. So again, when I look at probabilities and the distribution ahead of me, I also look at this tail risk that inflation doesn't slow down as the Fed wants, and they need to react in a more than proportionate way. And the bond market is assigning a 15% probability of such a reaction. So, something to bear in mind. I just wanted to give this as a thought to the audience. So I have one small pushback on the easy money on the 4% story, but I would first like to agree with you that one needs to be nimble. And I mentioned before that, again, if supply bottlenecks would ease all of a sudden, that would provide quite a respite to inflationary pressures and to the Fed, and they would be able to take some of the tightening pressure off, and that would definitely help a lot of risk assets that have been hammered by expectations of a Fed being relatively hawkish. So we have to keep our eyes open, obviously, for these developments. In the meantime, if nothing changes, I believe the path of least resistance, because of the many reasons I explained, is to continue sliding down in this bear market. Now, on the 4% story of Treasury yield, but guys, the 4% Treasury yield not being a deterrent for risk asset returns or forward risk asset returns. So the pushback I have there is that yields should be looked at against equilibrium levels. So what I say is that in an economy where demographics is extremely supportive, the labor force is expanding, we have more people actively contributing to the economic growth, we have productivity pickup, obviously the cost of capital can be higher without affecting economic returns. And that is what we have seen in the 60s, in the 70s, in the 80s. And since then, the labor supply growth has slowed down materially because of, the demographics. The post-Second World War demographic boom had come to an end effectively when it came to the labor force growth. And we have started declining. And also productivity growth had stabilized around about 1.5% a year. So we become more productive year after year. But the Industrial Revolution, post-Second World War, reforms that have been implemented actually had waned away in terms of their impact. And therefore, the equilibrium real interest rates became lower and lower, which also meant, JK, that if Treasury yields rose to levels which were, lower highs compared to before, you started to see some trouble. And I put a chart on Twitter on the Macro Compass showing how the Federal Reserve has hiked 3 times over the last 20 years to a peak Fed funds rate, which was always lower than the previous peak. So in 2000, we did, I think, 6% or so. And then in 2007, we did 5%. And then in 2018, the latest hiking cycle, we did shy of 3%. And now this time, so what this tells you basically is that the equilibrium real interest rate that the economy can take has gone down, which also means that you should measure the hiking cycle against this equilibrium. Now we are at the point where the Federal Reserve is telling us we need to be, we will be extremely serious on inflation. That's what they told us. Powell makes this speech before the FOMC conference talking to Americans. He understands their trouble. He's going to do everything in his power to slow down inflation. Nevertheless, they're talking about hiking interest rates to below 3%. And why is that? Because the equilibrium interest rates, and they know that the equilibrium interest rates have come down and they're still very low because of poor demographics and a pretty stagnant productivity. So if treasury yields would go to 4%, the 4% of 2020s is a very different 4% of the 1970s. The 4% in treasury yields this time is much more restrictive, is much higher than the equilibrium rate than the 4% of 1970s, because demographics is worse, because productivity is worse, because we have much more unproductive debt in the private and in the public sector. So that's the only pushback I would like to give, is that when we regress the levels at which interest rates cause a shock in risk assets and in the economy, we should always remind ourselves not to look at interest rates in a silos, but to look at interest rate against equilibrium. And the equilibrium is, derived from the level of unproductive debt, from demographics, and from productivity. And all of that has gone worse, obviously, over the last 40 years.
I want to be respectful of Alf's time. We already went over. So everybody that's here again, please make sure you follow Alfonso. I'm going to have another space in literally 15 minutes with Tavi Costa as the special guest for that hour. I'm doing these spaces because I'm also building out my YouTube channel. You see that on the top here. I'll make this edited and have that published in a week or two. Alfonso, you are clearly younger than I am because you have unbounded energy. So I appreciate all of the relentless knowledge you've dropped on everybody, and we'll hopefully do it again soon. Thank you, everybody, and again, you'll see another space from me in 15 minutes with Tavi Costa. Thank you,
Ciao,
everybody.
guys.